This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
Welcome back to TradeFlow TV. You know the drill. Markets move fast, and if you're not ahead, you're under. The geopolitical premium is back with a vengeance. Let's get you caught up. The 60-second commodities flash. First up, peace talks stall. The highly anticipated U.S.-Iran peace talks just lost major momentum. President Trump canceled his envoy's visit to Islamabad over the weekend. With Iran demanding vessels seek transit approval, shipping data shows the Strait of Hormuz remains virtually paralyzed, with just one tanker entering the Gulf on Sunday. Crude's upside shock, oil prices are extending their massive rally. Brent crude surged over 2% to hit $107.49 a barrel, while WTI advanced to $96.17. With the supply outlook tightening, analysts warn that prolonged disruptions could push crude into the 110 to 150 range. Gold's dollar tug-of-war. The yellow metal is caught in a brutal tug-of-war. Spot gold broke key support, dipping below 46.67, as the combination of a hawkish U.S. dollar and spiked crude prices triggered heavy selling. Tether cools on gold, adding to the precious metals pressure. Stablecoin giant Tether just revealed it drastically slowed its gold purchases for USDT reserves in the first quarter. The issuer purchased only about 6 metric tons as the market pivots. The copper paradox, Dr. Copper is flashing major warning signs. Despite a physical supply surplus, speculative funds are keeping prices artificially elevated near $13,000 per metric ton. The disruption in sulfuric acid supplies tied to the Middle East conflict is adding intense pressure to smelters globally. Deep dive: the copper paradox and the Hormuz ripple effect. The collapse of peace talks is triggering a paradox in base metal markets. The hottest topic in the trading pits right now isn't just the price of oil, it's what the Strait of Hormuz blockade is doing to base metals, specifically copper. We are witnessing what analysts are calling the copper paradox. While energy markets respond immediately to the strait's closure, the ripple effect on industrial metals is fundamentally altering global trade liquidity. Here is why copper is the ultimate proxy for this crisis. Point 1. The sulfuric acid chokehold. Copper leaching processes account for roughly 25% of global refined copper output. These hydrometallurgical operations require massive amounts of sulfuric acid. With the Strait of Hormuz closed, not only do energy costs spike, but the primary chemical reagent needed for copper smelting is threatened. This creates a hidden liquidity drain where smelters cannot finance production because their input materials are trapped behind a geopolitical wall. Point 2, the speculative illusion. Right now, London Metal Exchange 3-month copper is trading near $13,000 per ton, signaling massive scarcity. But here is the paradox. Exchange warehouses are full of metal and the market is in deep contango, signaling abundance. Money managers are currently holding massive net long positions. Financial positioning has effectively suspended its relationship with fundamental physical reality. When speculative capital overrides physical supply, physical traders are forced to post higher margins to hedge, draining working capital from the actual movement of goods. Point 3, the stagflationary demand destruction. The longer the Strait of Hormuz remains restricted, the more severe the macroeconomic damage. Elevated energy prices act as a direct inflationary tax, increasing costs across copper-consuming manufacturing industries. As inflation risks mount, central banks are incentivized to maintain high rates, which fuels continued strength in the U.S. dollar. A strong dollar combined with expensive energy ultimately destroys end-user demand. It's a vicious cycle where supply is choked, prices are artificially pumped, and real-world buyers are priced out. The TradeFlow take. We are watching the financialization of geopolitics in real time. The collapse of the Islamabad peace talks means the temporary Hormuz disruption is threatening to become permanent. Until that waterway reopens, expect massive volatility, deep contango traps, and a brutal margin squeeze for mid-tier merchants. Stay liquid, stay sharp. See you on the next one.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.